this video I'll be giving you 3 good steps for day trading. Just 3 good steps on how to day trade. Simple, clean and clear. So let's leave too much talking and show actual workings now. So for the first step, we'll be using the daily time frame. What is the daily time frame used for? Remember in our previous video on the market structure shift, I said you need to know your trend. So the trend is very important. It's just like a surfer that want to ride it, that just jump in the ocean. You want to ride against the tide. The tide will surely cross that surfer. But if you want to enjoy your surfing, you have to ride the tide. That's the same thing in the market. So the first thing, you need to know your trend. Know your trend. As you can see in this trend, in the daily time, the market is obviously bearish. Now I've gotten our trend. Then we head over to the 15 minutes time frame. Now we are on the 15 minutes time frame. All we have to do is look for a liquidity grab in the market. Now that the market is the trend is bearish, we are looking to short the market, we are looking to sell this pair. The paper we are using here is GBP USD, so we are looking to short GBP USD. Please, this is a back tested trade, or yes, we are back testing the trade. We are using the replay for this trade. So don't think that is happening live. So I want to give you an example. So that you can use that example, enter your live chat and observe it yourself. So, but before you look for the liquidity grab, you have to identify your market sessions. We have the London, we have the Asian, London, and New York. The main sessions we're using in this place is just the London and New York key zones. Why? Because this is GBP USD. GBP is for the London session, while USD is traded at the US in New York session, which is these countries are London and US, right? So GBP USD will function more, will move more on the London and the New York session. That's why we're using the London and New York session in this particular feed. Now the London session has been marked out, which is 2 a.m. to 5 a.m. London, which is New York. We're using New York time here, so change your trading view time to New York time. So that is 2 to 5. That's the London key. So why are we using time here? Time is always greater than price. You can use the NFP as an example now. When the NFP wants to happen, the NFP happens around 1:30 New York time, right? Before that 1:30, the market does not make any sudden movement. That sudden movement happens exactly 1:30. It does not happen 1:15. It does not happen 1:20. The NFP move happens at 1:30 exactly. So price is very sensitive to time. That's why we are very sensitive to time. Is always better than price. So let's go. Let me just forward it so fast. So the second step is we mark out the liquidity zone, which in this place we're using the buy side. What's the buy side? An old high. We use an old high here. This is the liquidity zone. Our levels have been set. We just have to wait for the markets to trade above this level before we can start looking for an entry in the market. Yes, yes, correct. So the market has traded above the first liquidity zone. So now we have to wait for the market to get into the Q zone. Then we can start looking for the market structure shift. If you don't know what the market structure shift is, please go back to the previous video I did. Market structure shift, you will see it there. Let's go. I have to wait for the market. Oh, whoa, what a movement. Now you are done with the second step. The third step is look for your market structure shift. The second step is your liquidity graph. This market has become this buy side. So the third step now is check your 55 minutes or 3 minutes time frame for a market structure shift. Now we are on the 3 minutes time frame. So this is the third step. All we have to do now is look for a market structure shift in the market around our Q, inside our Q zone. As you can see, exactly 2 o'clock. At 2 o'clock candle, there was a sudden drop in the market. Now look, before the sudden drop in the market first took out this high. You see, the load that was responsible for creating that high is where this low. particular low here. You can see this is the low I was responsible for taking out this high. So this low will be where it will be our displacement low. So we have our displacement low and displacement high. So all we have to wait for now is market to get into the liquidity, into the fair value gap that was created inside this range. You can see this is a fair value gap here. This is the fair value gap. Fair value gap FVG. Shout out to ICT. Now, shout out to ICT. Let me see it again. Shout out to ICT. Now, we have the fair value gap. Your stop loss, your entry will be inside the fair value gap, and as you can see, the market has already tapped the fair value gap, so we enter immediately. Particular zone. Then your stop loss will be at the displacement high. Remember, what is the meaning of stop loss? Stop loss is a place in price that invalidates your entry. Now we go for a risk reward of 1 to 2. Please don't go for high risk to reward. Always go for low risk. So what is very achievable? Let's see how the trade plays out. Because you can see it's going to our stop loss level. Let's watch this video. Whoa, can you see that? Nice. What a replacement. Boom. TP hit. Nice. TP hit. So this is how we trade. I don't want to make this video a long video. So if not, I would have given more examples of this. So please, I beg you in the name of God, just go to your chart and follow this exact same steps that I showed you. So let's go over the steps again. The first step is know your trend, which you use the daily time frame for. You can use the 4-hour time frame. You always go for a higher time frame, the daily time frame and the 4-hour time frame. But in this video, we use the daily time frame. The second step is look for the 15 minutes liquidity grab. There must be a liquidity grab prior to the session, to your London or New York session. There must be a liquidity grab. So in this video we used the trend was bearish, so we used the buy side liquidity. So we have to wait for an old 15 minutes high. Old 15 minutes high to get taken out first. Then after the market has taken out the 15 minutes high, we drop down to the 3 minutes or 5 minutes or 3 minutes time frame. Nothing less than that. Don't go below 3 minutes or 5 minutes time frame. Then wait for a market sensor shift. And that market sensor shift must occur inside your kill zone, not outside. It must happen inside your kill zone. When your market sensor shift happens, you go for a risk to reward of 1:2. Or if you want to go crazy, go for 1:3 highest. It is very achievable. Always go for the low hanging fruit. The law of compound effect is real. All these small profits stack up. If you ask yourself why are you blowing your account constantly, just go to your history and look at all the losses, all the small losses you are taking, blow your account. That is the same thing. Go for small wins, but to make your losses smaller, or let's go for low risk to reward. Don't go for high risk. Don't looking for one to make 1 billion. That is crazy. So do well to like this video so the algorithm can share it to more people like you, and do well to share to your friends. Follow me for more content. I am on Twitter and YouTube. Do well to subscribe to my YouTube channel and follow me on Twitter to get more of it. I have a free Telegram channel where I drop daily signals and trading tips. You can also join. Just comment the word Telegram and I will send you the Telegram.